It was Thursday, October 24th, 1929, and New York City hummed with the electric confidence of a nation that believed it had conquered scarcity itself. The previous decade, the Roaring Twenties, had been a carnival of excess. Jazz, speakeasies, flappers, and above all, easy money. Everyone was getting rich, or so it seemed. On Wall Street, the heart of American capitalism, the morning opened with nervous energy. Stock prices had been wobbling for weeks, but optimism remained the prevailing religion. Ordinary Americans, shopkeepers, teachers, factory workers, had poured their savings into the market, seduced by stories of instant wealth. Buying stocks on margin meant you could control $100 worth of shares with just $10 down. It was leverage, and it was intoxicating. The streets around the New York Stock Exchange were already crowded by 9 a.m. Traders, clerks, messengers, and speculators filed into the imposing neoclassical building at 11 Wall Street. The marble columns and bronze doors projected permanence, stability, inevitability. This was the temple of American prosperity, and every morning felt like a pilgrimage. Inside, the trading floor was a cathedral of commerce, a vast hall with soaring ceilings, rows of trading posts, and the constant clatter of ticker tape machines. These mechanical marvels were the nervous system of capitalism, printing stock prices on thin ribbons of paper that unfurled like prophecies. Brokers studied them like priests reading omens. But by mid-morning, something was wrong. The ticker tape machines, those mechanical oracles that spat out stock prices on thin ribbons of paper, began to lag. Prices were falling so fast the machines couldn't keep up. By noon, they were running hours behind reality. Brokers squinted at outdated information, trying to make sense of a market that was already in freefall. The lag wasn't just inconvenient, it was catastrophic. When you don't know the current price of a stock, you can't make rational decisions. Panic fills the void where information should be. And panic, once it starts, feeds on itself. The Roaring Twenties. The bubble inflates. To understand what happened on Black Thursday, you have to understand the madness that preceded it. The 1920s were a time of unprecedented transformation in America. The Great War, World War I, had ended in 1918, and the United States emerged as the world's dominant economic power. Europe was devastated, its cities bombed, its economies shattered. America, by contrast, was ascendant. Factories that had produced weapons now produced consumer goods. The assembly line revolutionized manufacturing. Automobiles, radios, refrigerators, and telephones became mass-market products. It was the birth of modern consumer culture, and it was intoxicating. Credit became widely available for the first time. You could buy a car on installment plans. You could furnish your home with next month's wages. The future was something you could borrow against, and millions of Americans did exactly that. Nowhere was this optimism more concentrated than in the stock market. Between 1922 and 1929, the Dow Jones Industrial Average nearly quintupled, rising from around 60 points to a peak of 381 in September 1929. Millionaires were minted overnight. Newspapers ran breathless stories about ordinary people, secretaries, barbers, taxi drivers, getting rich from stocks. Everyone ought to be rich, declared John J. Raskob, a General Motors executive and chairman of the Democratic National Committee, in a famous 1929 article for Ladies' Home Journal. He laid out a simple plan. Invest $15 a month in good common stocks, and in 20 years you'd have $80,000, equivalent to over $1.3 million today. It was financial salvation, democratized. The message was everywhere. The stock market was the path to prosperity, and anyone could walk it. But there was a catch. Margin trading. Borrowed dreams. The boom was built on debt. Buying on margin became the defining feature of 1920s investing. Here's how it worked. You wanted to buy $1,000 worth of stock, but you only had $100. No problem. Your broker would lend you the other $900. As long as the stock price went up, everyone was happy. You'd sell the stock, pay back the loan with interest, and pocket the profit. It was leverage, and it magnified gains spectacularly. If the stock doubled, you didn't just double your $100. You made $1,000, minus the loan and interest. That's a 900% return on your actual investment. But leverage cuts both ways. If the stock price fell by just 10%, your $1,000 investment was now worth $900. Exactly the amount you owed the broker. Fall any further, and you'd get a margin call. Pay up immediately, or we'll sell your stock to cover the loan. And if the stock crashed, you could lose everything you'd invested and still owe money to the broker. By 1929, margin debt had reached unprecedented levels. Estimates suggest that up to 90% of the market's value was purchased on margin. The entire stock market was a house of cards built on borrowed money. Banks and brokers loved it. They were making fortunes on the interest from margin loans. The more people borrowed, the more money everyone made, as long as prices kept rising. But prices can't rise forever. The warning signs ignored. Not everyone was blind to the danger. In early 1929, the Federal Reserve, then a relatively new institution, created in 1913, grew concerned about the speculative frenzy. They raised interest rates, hoping to cool down the market. It was a warning shot. Easy money was coming to an end. Some astute observers saw the writing on the wall. Roger Babson, a financial analyst, gave a speech in September 1929 predicting that a crash is coming, and it may be terrific. The market dropped sharply that day. It became known as the Babson break, but recovered within days. Babson was mocked as a pessimist, a killjoy, a man out of touch with the new era of prosperity. Paul Warburg, a prominent banker and one of the architects of the Federal Reserve, warned in early 1929 that the market was overheated and heading for disaster. He was ignored. Joseph P. Kennedy, the father of the future president, famously decided to sell all his stocks after receiving stock tips from his shoeshine boy. His reasoning was simple. If even shoeshine boys are speculating in stocks, the market has run out of new buyers. And when there are no new buyers, there's nowhere to go but down. These men understood something fundamental. The stock market isn't just about companies and profits. It's about psychology, confidence, momentum, the greater fool theory. As long as everyone believes prices will keep rising, they do. But once that belief cracks, the whole structure collapses. And in October 1929, the cracks were spreading. The first tremors, late September to early October. The market peaked on September 3, 1929, with the Dow hitting 381.17. From there, it began a slow, uneven decline. At first, it seemed like a normal correction. Markets don't go up in straight lines, after all. Dips are healthy, analysts said. It's a chance to buy at a discount. But the dips kept coming. On October 3, the British government announced that the Clarence Haytree financial empire had collapsed due to fraud. Haytree, a prominent British financier, had been running a massive scheme involving forged collateral. The scandal sent shockwaves through London and rippled across the Atlantic. Confidence wobbled. By mid-October, the selling had intensified. Small investors, the little guys who had bought on margin, started to get nervous. They'd been told stocks only go up, but their portfolios were shrinking. Some decided to sell before things got worse. Each sale pushed prices down a little more. Each dip triggered margin calls. Each margin call forced more selling. The feedback loop was accelerating. On Monday, October 21st, the market dropped sharply. Trading volume spiked. The ticker tape began to lag, a bad sign. On Tuesday, there was a brief rally, but it felt fragile. Then came Wednesday, October 23rd. Wednesday, the day before the storm. October 23rd was the day the dam truly cracked. The market opened weak and got weaker. By mid-afternoon, a wave of selling had overwhelmed the trading floor. The Dow dropped 6.3%, a staggering loss for a single day. Over 6 million shares changed hands, far above normal volume. The ticker tape fell hopelessly behind. Brokers couldn't see current prices. Panic began to set in. Margin calls went out by the thousands. Investors who had borrowed to buy stocks were being told to pay up immediately, or their shares would be sold at a loss. Many couldn't pay. Their stocks were liquidated, driving prices down further, triggering more margin calls. It was a death spiral. By the closing bell, the financial community was in shock. Newspapers ran worried headlines. Analysts scrambled for explanations. Ordinary investors lay awake that night, staring at ceilings, wondering if they should sell in the morning, or if it was already too late. Thursday, October 24th, dawned cold and gray. Part 2. Black Thursday. The collapse 10:00 a.m. The opening bell. The New York Stock Exchange opened at 10 a.m., as always. Within minutes, it was clear that Wednesday's decline had been just a prelude. Sell orders flooded in. Not hundreds, thousands. Not from one region, from everywhere. Small investors, institutional investors, banks, trusts, everyone wanted out at once. The trading floor descended into chaos. Men in three-piece suits shouted themselves hoarse. Hands shot up in desperate signals. Buy. Sell. The words lost meaning as the crowd became a single organism driven by terror. Phones rang endlessly, thousands of margin calls flooding in from across the country. Brokers screamed into receivers, trying to hear over the din. The ticker tape machines clattered furiously, but they couldn't keep pace. By 10:30 a.m., they were 15 minutes behind. By 11 a.m., 30 minutes. The lag grew and grew, like a wound that wouldn't stop bleeding. This was the nightmare scenario. Price discovery had broken down. When you don't know what a stock is worth right now, only what it was worth half an hour ago, you can't make rational decisions. All you can do is guess. And in a panic, everyone guesses the worst. Brokers sold shares at whatever price they could get. Stocks that had been worth $100 last week were going for $50, then $40, then $30. Fortunes built over decades evaporated in minutes. 11 a.m. The crowd gathers. Outside, on Broad Street and Wall Street, a crowd had begun to gather. Word spread fast in Manhattan. Something terrible is happening at the exchange. Office workers on their lunch breaks, delivery drivers, shopkeepers, reporters, thousands of people converged on the financial district. They stood in stunned silence, staring up at the neoclassical temple of capitalism as if waiting for an explanation that would never come. Police were called in to manage the crowd. Rumors spread. Brokers were jumping from windows. Banks were failing. The entire financial system was collapsing. Most of the rumors were false, but they reflected the terror that gripped the city. Inside the exchange, the situation was deteriorating by the minute. 11:30 a.m. The emergency meeting. At 11:30 a.m., Charles E. Mitchell, chairman of National City Bank, predecessor to Citibank, left the trading floor and walked across the street. He entered the offices of J.P. Morgan & Company, the most powerful financial institution in America, perhaps the world. Within minutes, the most powerful bankers in the country had assembled in Morgan's conference room. The group included Thomas W. Lamont, senior partner at J.P. Morgan, Charles E. Mitchell of National City Bank, Albert H. Wiggin of Chase National Bank, William C. Potter of Guarantee Trust Company, Seward Prosser of Bankers Trust. These men controlled the commanding heights of American finance. Between them, they had access to billions of dollars in capital. If anyone could stop the panic, it was them. The meeting lasted less than 20 minutes. They emerged with a plan: pool their resources, $240 million, a staggering sum, and use it to stabilize the market. The strategy was simple: place large, visible buy orders for blue-chip stocks at prices above the current market. Signal to the world that the panic was unjustified, that quality stocks were worth buying, that confidence should return. It was a psychological operation as much as a financial one. 12:30 p.m. Richard Whitney's walk. At 12:30 p.m., Richard Whitney strode onto the trading floor of the New York Stock Exchange. Whitney was the vice president of the exchange, but more importantly, he was the floor broker for J.P. Morgan. Tall, impeccably dressed, exuding the unshakable confidence of the Eastern establishment. He was the perfect messenger for what came next. He walked deliberately through the chaos, past the shouting brokers and ringing phones, to the trading post for U.S. Steel, the bluest of blue-chip stocks, a symbol of American industrial might. In a loud, clear voice, he placed an order: 10,000 shares of U.S. Steel at $205 per share. The floor went silent. $205 was well above the current price. Whitney was offering to pay more than the stock was worth. The message was unmistakable. The bankers are here. The panic is over. Buy with confidence. Whitney then moved to other trading posts, AT&T, General Electric, other blue chips, placing similarly large, above-market orders. It was a theatrical performance, and it worked. Within an hour, the market stabilized. Prices stopped falling. Some even recovered. By the closing bell at 3 p.m., the Dow had clawed back much of its losses. It ended the day down only 2%, a miracle considering the morning's bloodbath. Nearly 13 million shares had traded hands, a record at the time. The ticker tape didn't catch up until after 7 p.m. But the crisis seemed to have passed. Evening. False hope. The evening newspapers ran hopeful headlines: bankers halt stock panic, worst is over, market stabilizes after wild day. Thomas Lamont of J.P. Morgan gave a statement to the press, downplaying the day's events. There has been a little distress selling on the stock exchange, he said, with patrician understatement. The bankers' intervention, he suggested, had restored order. That night, Wall Street breathed a sigh of relief. The little guys who had held on felt vindicated. See, the bankers stepped in. Everything's fine. The American economy is strong. But in the private clubs and offices of the financial elite, a different conversation was happening. Part 3. The Insiders Who Knew. While millions of ordinary Americans were panicking, a small group of financiers remained remarkably calm. This wasn't luck. It was knowledge. The men who sold early. Joseph P. Kennedy, as mentioned, had liquidated his entire portfolio before the crash. He even shorted the market, betting that prices would fall, and made a fortune as others lost everything. Kennedy would later become the founding chairman of the Securities and Exchange Commission, tasked with regulating the very practices that had made him rich. Bernard Baruch, the legendary financier and advisor to presidents, also cashed out early. Baruch had made his fortune through shrewd speculation, and he understood market psychology better than most. He saw the bubble for what it was and got out while the getting was good. John D. Rockefeller, the oil magnate and one of the richest men in the world, had reduced his stock holdings significantly in the months before the crash. On Black Thursday, he issued a public statement meant to calm markets. My son and I have for some days been purchasing sound common stocks. It was a reassuring message, but also a revealing one. Rockefeller was buying after the crash, at fire sale prices. The bankers who profited from the panic. The bankers who orchestrated the Thursday intervention were not selfless heroes saving the economy. They were protecting their own interests, and positioning themselves to profit from the chaos. Albert H. Wiggin, chairman of Chase National Bank, publicly urged confidence while secretly shorting his own bank stock. He made millions betting against the institution he led, all while telling depositors and investors that everything was fine. Wiggin's actions were legal at the time. There were no laws against insider trading, but they revealed the utter cynicism at the heart of the financial system. Charles E. Mitchell of National City Bank had been one of the most aggressive promoters of stock market speculation during the 1920s. His bank had sold securities to ordinary Americans with misleading information, encouraging them to buy on margin. When the crash came, Mitchell's bank foreclosed on countless customers, seizing their assets. Mitchell himself was later investigated for tax evasion, though he escaped criminal conviction. Richard Whitney, the man who had walked so confidently across the trading floor, would later be revealed as a fraud. In the 1930s, Whitney embezzled money from the New York Stock Exchange and was sent to prison. But on Black Thursday, he was the face of stability, a symbol of an order that was already rotten. The information asymmetry. What these men had in common was access to information and power that ordinary investors lacked. They knew the market was overvalued because they had helped overvalue it. They knew the margin loans were unsustainable because they had issued them. They knew a correction, or a crash, was inevitable because they understood the mechanics of leverage and panic. And when the crash came, they were ready. This is the dark secret of financial markets. Insiders don't lose in crashes. They reposition. They sell at the top, buy at the bottom, and emerge wealthier than before. The little guys, the shopkeepers, the teachers, the factory workers who believed in the American dream, they're the ones who lose everything. Because when the game is rigged, the house always wins. Part 4. The Weekend. a false calm. Friday, October 25th, brought a sense of cautious optimism. The market opened shakily but held. Trading volume remained high, but there was no repeat of Thursday's panic. Prices were volatile but didn't collapse. The newspapers continued their reassuring narrative. The crisis had passed, the bankers had saved the day, normalcy was returning. Over the weekend, millions of Americans tried to make sense of what had happened. Families gathered around radios, listening to financial experts offer conflicting advice. Some said hold on, the market will recover. Others said sell while you still can. In churches across the country, ministers preached about greed and hubris, about the dangers of worshipping mammon. In pool halls and speakeasies, working-class Americans who had never owned a stock shook their heads and said they'd known it was all a sham. On Wall Street, the bankers met again. Their $240 million intervention had bought time, but it hadn't solved the underlying problem. The market was still massively overvalued, and millions of investors were still buried in margin debt. The question wasn't whether there would be another crash. The question was when. Monday, October 28th. Black Monday. The answer came Monday morning. The market opened in freefall. There was no hesitation, no temporary dip followed by stabilization. Just a straight, brutal plunge. By the closing bell, the Dow had dropped 13.5%, the second worst day in its history. Nearly 9 million shares traded hands. The ticker tape once again fell hopelessly behind. The bankers did not intervene this time. Whether they couldn't or wouldn't is a matter of debate. Perhaps their resources were exhausted. Perhaps they realized the crash was unstoppable. Or perhaps, and this is the darker interpretation, they recognized that further intervention would only deepen their own losses. Better to let the market fall, wipe out the over-leveraged speculators, and pick up the pieces later at bargain prices. That night, the mood in America turned from anxiety to despair. But the worst was still to come. Tuesday, October 29th. Black Tuesday, the day Wall Street died. If Black Thursday was chaos and Black Monday was devastation, Black Tuesday was apocalypse. The market opened in complete collapse. Sell orders poured in by the tens of thousands. Entire fortunes were liquidated in minutes. Stocks that had been worth millions were sold for pennies on the dollar, or couldn't be sold at all because there were no buyers. 16 million shares traded hands, a record that would stand for nearly 40 years. The ticker tape didn't catch up until after 7 p.m. The Dow plummeted 12% in a single day. By the end of Black Tuesday, the market had lost 25% of its value in just 2 days. Over the course of the week, from Black Thursday to Black Tuesday, $30 billion in market value had vanished. To put that in perspective, $30 billion in 1929 is equivalent to roughly $500 billion today. It was more than the entire cost of American involvement in World War I. But the raw numbers don't capture the human devastation. The human toll. Suicides, ruin, and despair. The stories that emerged from Black Tuesday are the stuff of American tragedy. Winston Churchill, the British statesman, was visiting New York at the time and witnessed the crash firsthand. He later wrote about seeing a man throw himself from a building near the Exchange. Whether Churchill actually witnessed a suicide or heard a second-hand account is unclear, but the image became part of the mythology of the crash. There were, indeed, suicides. The exact number is disputed. Many of the reported leaps from windows were exaggerated or fabricated by sensationalist media. But there's no question that the crash drove some men to despair so deep that death seemed preferable to financial ruin. James J. Reardon, president of the County Trust Company, shot himself after Black Thursday. Ivar Kreuger, the Swedish match king, who had built a financial empire on fraud, would commit suicide in 1932 when his schemes unraveled. Jesse Livermore, the legendary speculator who made $100 million shorting the crash, would eventually lose it all in later years and take his own life in 1940. But the real devastation wasn't in the headlines. It was in the quiet ruin of millions of ordinary people. A schoolteacher in Ohio who had put her life savings, $3,000, into the market, hoping to secure her retirement. Gone. A shopkeeper in Chicago who had bought stocks on margin, believing his broker when he said it was a sure thing. Ruined, and now in debt. A young couple in California who had mortgaged their home to invest in the market, certain they were building a better future for their children. Foreclosed. These were the real victims of Black Tuesday. Not the speculators and bankers who lost fortunes. They had fortunes to lose. But the working people who had believed in the promise of American capitalism, who had trusted the system, who had done what they were told. They lost everything. And unlike the bankers, they would never get it back. Part 5. The Great Depression. A Nation in Ruins. The stock market crash of 1929 was not, by itself, the cause of the Great Depression. Historians debate the relative importance of various factors: agricultural overproduction, the international gold standard, tariff wars, bank failures, monetary policy mistakes. But the crash was undeniably the spark that ignited the conflagration. The cascade of failures. Within months, the financial contagion spread throughout the economy. Banks began to fail. In 1930 alone, over 1,300 banks collapsed. When a bank failed, its depositors lost everything. There was no FDIC insurance, no federal guarantee. Life savings vanished overnight. As banks failed, credit dried up. Businesses couldn't get loans. Factories closed. Unemployment soared. By 1933, 1 in 4 Americans was out of work. Consumer spending collapsed. Why would you buy a new car or a radio when you didn't know if you'd have a job next month? The factories that had hummed with prosperity in the 1920s went silent. Assembly lines stopped. Workers were laid off by the millions. Agriculture, already struggling due to overproduction and falling prices, collapsed entirely. Farmers couldn't pay their mortgages and lost their land. The Dust Bowl, a catastrophic environmental disaster caused by drought and poor farming practices, turned the Great Plains into a wasteland. Millions of farmers migrated west, becoming the Okies immortalized in John Steinbeck's The Grapes of Wrath. Hoovervilles and breadlines. Homelessness exploded. Across the country, shantytowns sprouted in city parks and vacant lots. They were derisively called Hoovervilles, after President Herbert Hoover, who was widely blamed for the Depression. These makeshift communities were built from scrap wood, cardboard, and sheet metal. Families huddled together for warmth. Children went hungry. Men who had once been middle-class professionals now stood in breadlines, waiting for a bowl of soup and a piece of bread. The psychological impact was profound. The 1920s had promised limitless prosperity, and millions had believed. Now that promise had been revealed as a lie. Faith in the system, in capitalism, in democracy, in the American dream itself, was shattered. The political response: too little, too late. President Herbert Hoover, a brilliant engineer and humanitarian who had organized relief efforts during World War I, was utterly unprepared for the crisis. Hoover believed in limited government and voluntary cooperation between business and labor. He thought the economy would self-correct if left alone. He opposed direct federal relief, arguing that it would create dependency and undermine American self-reliance. He was catastrophically wrong. By 1932, the country was in freefall. Unemployment was at 25%. Industrial production had fallen by nearly half. Hoover's approval ratings collapsed. In the 1932 presidential election, he was crushed by Franklin Delano Roosevelt, who promised a New Deal for the American people. Part 6. The New Deal: Reform or Consolidation. Franklin Roosevelt took office in March 1933, at the absolute nadir of the Depression. Banks were failing daily. Unemployment was still rising. The country was on the brink of collapse. Some feared revolution. Roosevelt's inaugural address was a masterclass in leadership. The only thing we have to fear is fear itself. He projected confidence, decisiveness, and a willingness to experiment. Within his first 100 days, he pushed through a flurry of legislation aimed at stabilizing the economy and providing relief to the suffering. The New Deal included the Emergency Banking Act, which closed insolvent banks and reopened sound ones; the Federal Deposit Insurance Corporation, FDIC, which insured bank deposits up to $5,000; the Securities and Exchange Commission, SEC, which regulated the stock market; the Glass-Steagall Act, which separated commercial and investment banking; the Social Security Act, which created a safety net for the elderly and unemployed; The Tennessee Valley Authority, which brought electricity to rural areas. The Works Progress Administration, which employed millions in public works projects. On the surface, it looked like a revolutionary transformation. The taming of capitalism, the creation of a social safety net, the end of the robber baron era. But look closer, and a different story emerges. The bankers who survived and thrived. The same financial institutions that had caused the crash were now central to the recovery. J.P. Morgan and Company advised the Roosevelt administration on financial policy. Chase National Bank and National City Bank survived the Depression and emerged even larger, having absorbed failed competitors. The New Deal regulations, while genuine reforms, also had the effect of consolidating power among the largest financial institutions. Smaller banks failed by the thousands. Larger banks absorbed their assets. By the end of the 1930s, a handful of megabanks controlled a larger share of American finance than ever before. The SEC, created to prevent another 1929, was chaired by Joseph P. Kennedy, the man who had made millions shorting the market during the crash. Roosevelt's reasoning was cynical but pragmatic. It takes a thief to catch a thief. Wealth concentration accelerates. While millions of Americans lost everything in the Depression, the wealthiest Americans, those who had sold before the crash or bought at the bottom, emerged richer than ever. The Rockefeller family increased its wealth during the 1930s by buying undervalued assets. The DuPont family, industrialists and investors, did the same. Andrew Mellon, Hoover's Treasury Secretary and one of the richest men in America, bought art and real estate at Depression prices and built a fortune that would last generations. This is the uncomfortable truth about economic crises. They redistribute wealth upward. The poor and middle class lose their savings, their homes, their security. The rich lose some paper wealth, but they have the capital to wait out the storm and the resources to buy assets at fire sale prices. By the time the Depression ended, the wealth gap in America had actually widened. Part 7. The Echoes in Our Time. If this story sounds familiar, it should. The 2008 financial crisis followed a strikingly similar pattern. Reckless speculation. In the 2000s, it was housing instead of stocks. Subprime mortgages, collateralized debt obligations, mortgage-backed securities, complex financial instruments that promised easy wealth. Excessive leverage. Just as the 1920s saw margin trading, the 2000s saw massive leverage among banks and homeowners. When housing prices fell, the entire structure collapsed. Insider knowledge. Wall Street executives knew the housing bubble was unsustainable. Some, like the traders depicted in The Big Short, even bet against the market and made fortunes. Government bailouts. When the crash came, the biggest banks were deemed too big to fail and rescued with hundreds of billions in taxpayer money. Ordinary homeowners received far less help. Wealth concentration. After 2008, wealth inequality accelerated. The richest Americans recovered quickly. The middle class did not. The parallels are not coincidental. They reflect the fundamental structure of modern capitalism. Crises are not aberrations. They are features of the system. Why crashes happen again and again? Economic bubbles and crashes follow a predictable pattern. Innovation or policy change creates new investment opportunities. Easy credit fuels speculation. Prices rise faster than fundamentals justify. Insiders begin to sell. Confidence cracks. Panic spreads. Crash wipes out over-leveraged investors. Assets are bought at fire sale prices by those with capital. System resets, with wealth more concentrated than before. This cycle has repeated throughout history. The tulip mania of 1637, the South Sea bubble of 1720, the Panic of 1837, the Panic of 1907, the 1929 crash, the dot-com bubble of 2000, the 2008 financial crisis. Each time, the same story. Ordinary people believe in a new era of prosperity, insiders cash out early, the bubble bursts, the masses lose everything, and the powerful emerge stronger. Part 8. The Lesson They Don't Teach. History textbooks teach the Great Depression as a cautionary tale about unchecked speculation and the need for regulation. It's presented as a tragedy, a disaster, a failure of the system. And for the millions who suffered, it was exactly that. But for the financial elite, it was something else entirely. It was a reorganization of power. A chance to buy assets at depression prices. A moment to rewrite the rules in their favor. They didn't lose everything. They took it back later. Asterisk asterisk. This is the sentence that encapsulates the real story of Black Thursday and the Great Depression. While millions of Americans lost their homes, their savings, their futures, the financial elite who caused the crisis not only survived, they thrived. They had access to information. They understood the mechanics of bubbles and crashes. They got out early. And when the dust settled, they bought back everything they'd sold, and more, at a fraction of the price. Joseph Kennedy turned his crash profits into a political dynasty. The Rockefellers expanded their empire. J.P. Morgan and Company became even more central to American finance. The big banks grew bigger. The New Deal regulations, while genuine attempts at reform, did not fundamentally alter the structure of American capitalism. They smoothed some of its rough edges, created some safety nets, and prevented some of the worst abuses. But they did not change the fundamental dynamic. Capital concentrates. Crises accelerate concentration. The powerful survive, the powerless do not. Part 9. The Day Wall Street Died, or the Day It Learned to Never Die Again. The title of this story promises the day Wall Street died. But that's a lie, or at least a metaphor. Wall Street didn't die on Black Thursday. It didn't die in the Great Depression. It didn't die in 2008. What died was the illusion. The belief that the stock market was a meritocracy, that hard work and smart investing would be rewarded, that the system was fair. What survived was the structure. The banks, the brokerages, the networks of power and capital that control the economy. Wall Street didn't die. It evolved. Like a snake shedding its skin, it molted. The old excesses were discarded, the regulations absorbed, the language adjusted. But the core remained the same, a system designed to extract wealth from the many and concentrate it in the hands of the few. The architecture of extraction. To understand how this works, you have to understand the fundamental asymmetry of financial markets. When ordinary people invest, they're playing a game they don't fully understand, against opponents who wrote the rules. They don't have access to privileged information. They can't move markets with their trades. They can't get bailed out when they make mistakes. The financial elite operate under entirely different conditions. They have information asymmetry. They know what's happening inside companies, inside markets, inside regulatory agencies before the public does. Capital advantages. They can weather downturns, buy in crashes, and wait years for returns. Political influence. They shape the regulations that govern their behavior. Limited liability. When their bets go bad, they're often rescued by public money. This isn't a conspiracy in the traditional sense. There's no shadowy cabal in a smoke-filled room plotting the destruction of the middle class. It's something more systemic, more insidious. The rules of the game itself favor those who already have power. The revolving door. Look at who regulates Wall Street, and you'll see why it keeps winning. The SEC, created to prevent another 1929, has been run by Wall Street insiders for most of its existence. Joseph Kennedy was just the first. Treasury secretaries regularly come from Goldman Sachs and return to Goldman Sachs. Federal Reserve officials retire to lucrative positions at the banks they once regulated. This isn't corruption in the crude sense of cash-filled envelopes. It's cognitive capture. The regulators come to see the world through the eyes of those they regulate. They believe that what's good for Wall Street is good for America. They genuinely think that bailing out big banks protects ordinary people, even as ordinary people lose their homes. The result is a system that privatizes profits and socializes losses. When times are good, the banks keep the gains. When times are bad, taxpayers cover the losses. It happened in 1929. It happened in 2008. And it will happen again. Part 10. The mythology versus the reality. Let's be clear about what the standard narrative of the Great Depression teaches. The myth, unchecked capitalism led to disaster. Brave reformers stepped in, created regulations, and saved the system. The lesson is that capitalism needs guardrails, but with proper oversight, it works for everyone. The reality. The financial elite created a bubble, profited from it, crashed it, bought assets at depression prices, shaped the reforms to protect their interests, and emerged more powerful than before. The myth of meritocracy. One of capitalism's most seductive promises is meritocracy. Work hard, invest wisely, and you'll prosper. The 1929 crash revealed this as fantasy. The people who worked hardest, the farmers, factory workers, shopkeepers, lost everything. The people who invested wisely, by following expert advice, lost everything. The people who trusted the system lost everything. The only people who thrived were those who had insider knowledge, excess capital, and the willingness to exploit both. This wasn't a failure of capitalism. This is how capitalism works. Periodically, wealth is violently redistributed upward through crises that wipe out the vulnerable while the powerful position themselves to profit. The myth of reform. The New Deal is often celebrated as proof that capitalism can be reformed, that regulation can protect ordinary people from the excesses of the market. And to some extent, this is true. The reforms of the 1930s did create meaningful protections: deposit insurance, securities regulation, labor rights, Social Security. But ask yourself, who benefited most from these reforms? The big banks benefited from deposit insurance. It restored confidence in the banking system, which allowed them to continue operating. The regulations eliminated their smaller competitors while leaving the giants intact. The social safety net prevented revolution. It kept the system stable enough that capitalism itself was never threatened. The New Deal saved capitalism from itself. It did not fundamentally alter the distribution of power. By the 1980s, many of these reforms had been weakened or eliminated. Glass-Steagall, the law separating commercial and investment banking, was repealed in 1999. Financial deregulation became bipartisan orthodoxy. And in 2008, the pattern repeated. Part 11. The 2008 Echo. The parallels between 1929 and 2008 are so precise they're almost eerie. In the 2000s, banks convinced millions of Americans that home ownership was the path to prosperity. They offered mortgages to people who couldn't afford them, then bundled these toxic loans into complex securities and sold them to investors as safe bets. Wall Street executives knew these securities were garbage. Emails later revealed them joking about shitty deals and Big Short bets. Some traders, like Michael Burry and the protagonists of The Big Short, even bet billions that the housing market would collapse, and made fortunes when it did. When the crash came in 2008, millions of ordinary Americans lost their homes. Unemployment spiked. Retirement savings evaporated. The economy teetered on the edge of total collapse. And what happened? The big banks, the same institutions that had caused the crisis, were bailed out with $700 billion in taxpayer money, plus trillions more in Fed lending programs, implicit guarantees, and other support. Homeowners got far less help. Millions were foreclosed on. Families were evicted. The middle class was hollowed out. Meanwhile, the banks that received bailouts used the money to pay executive bonuses, buy up competitors, and expand their market share. By 2010, the biggest banks were even bigger than before the crisis. The wealth transfer. Between 2008 and 2020, something extraordinary happened. While ordinary Americans struggled with stagnant wages and rising costs, the wealth of America's billionaires more than tripled. This wasn't because they worked 3 times harder. It was because they bought assets at crash prices in 2008 to 2009. The Federal Reserve flooded the financial system with cheap money. Asset prices soared while wages stagnated. Tax cuts for the wealthy accelerated wealth concentration. By 2020, America's level of wealth inequality had returned to 1929 levels. The Gilded Age had returned, rebranded as the new economy. And then came 2020. The pandemic. The latest reset. When COVID-19 hit in 2020, the stock market crashed. Millions of Americans lost their jobs. Small businesses closed permanently. And what happened? The Federal Reserve and Congress pumped trillions of dollars into the economy. Some went to ordinary people: stimulus checks, unemployment benefits, small business loans. But far more went to propping up asset prices. The stock market recovered within months and then soared to record highs. Real estate prices exploded. Billionaire wealth increased by $1.8 trillion during the pandemic. Meanwhile, millions of Americans remain financially devastated. Evictions resumed. Medical debt mounted. The wealth gap widened further. The pattern held: crisis intervention that protects asset owners, wealth concentration. Part 12. Why it keeps happening. At this point, you might be asking, if this pattern is so clear, why does it keep repeating? The answer lies in the structure of power in capitalist societies. Capital is power. In a capitalist economy, those who control capital control the system. They fund political campaigns, lobby for favorable regulations, own media outlets that shape public opinion, and sit on the boards that make key decisions. This isn't conspiracy, it's just how power works. If you have billions of dollars, you naturally use some of that money to protect and expand your wealth. You hire lawyers to find tax loopholes. You fund think tanks that promote deregulation. You contribute to politicians who support your interests. Over time, this creates a system biased toward capital owners. Not through explicit corruption, though that exists, but through 1,000 small decisions that collectively tilt the playing field. The illusion of democracy. We're taught that democracy provides a check on economic power, that voters can elect leaders who will tax the rich and protect workers. Sometimes this happens, at least partially. The New Deal did create genuine reforms. The post-war period saw relatively low inequality and strong unions. But these periods are exceptions, not the rule. And even during these periods, the fundamental structure of capitalism remained intact. Why? Because campaigns cost money. Politicians depend on wealthy donors. Media is owned by capital. The narratives we hear are shaped by those who own the platforms. Complexity favors insiders. Financial regulation is so complex that only industry experts can navigate it, and those experts usually come from, and return to, the industry. Economic blackmail. If you regulate us, we'll move to another country / crash the economy / cause a recession. The result is that even well-intentioned reforms are watered down, loopholed, or eventually repealed. The ideology of meritocracy. Perhaps the most powerful tool for maintaining the system is the ideology that justifies it. We're told that the wealthy earned their money through hard work and intelligence. That the poor are poor because of bad choices. That the market is fundamentally fair, and inequality is the natural result of differences in talent and effort. This ideology serves a crucial function. It makes the system seem legitimate. If you believe that wealth is earned, then you'll accept inequality as just. You'll blame yourself for not being rich, rather than questioning the system that keeps you poor. But the history of crashes reveals the lie. The people who get rich in capitalism aren't necessarily the hardest working or most intelligent. They're the ones with access to capital, information, and power. Joseph Kennedy didn't work harder than the schoolteacher who lost her savings in 1929. He just had insider knowledge and the ruthlessness to exploit it. The hedge fund managers who made billions in 2008 didn't work harder than the families who lost their homes. They just understood the system better and positioned themselves accordingly. Part 13. What could be different? At this point, this story might feel like a counsel of despair. If the system is rigged, if crashes are inevitable, if wealth always concentrates upward, what's the point? But history also teaches us that systems can change. The moments of possibility. Crises create opportunities for transformation. In the chaos of collapse, old certainties dissolve. Suddenly, ideas that seemed radical become possible. The New Deal happened because the Depression created political space for it. Social security, unemployment insurance, labor rights, these weren't gifts from benevolent elites. They were won through struggle, through organizing, through the very real threat that if capitalism didn't reform, it would be replaced by something else. Similarly, after 2008, movements like Occupy Wall Street challenged the legitimacy of the financial system. Bernie Sanders' presidential campaigns brought ideas like Medicare for all and wealth taxes into mainstream debate. These movements didn't win, yet, but they shifted what's politically imaginable. What real reform would look like. If the goal is to prevent another 1929, another 2008, another cycle of boom-crash bailout concentration, we'd need reforms far more radical than anything in the New Deal. 1. Wealth taxes. Progressive taxation on extreme wealth. to prevent the kind of concentration that gives individuals and institutions disproportionate power. 2. Public banking. Banks that serve public interests rather than shareholder profits, that can't be too big to fail because they're accountable to citizens, not investors. 3. Worker ownership. Companies owned by their workers, not distant shareholders, so profits are distributed to those who create value rather than those who own capital. 4. Debt jubilees. Periodic forgiveness of debts that have become unpayable, preventing debt from becoming a permanent trap. 5. Capital controls. Limits on speculation, on leverage, on the kinds of complex financial instruments that create systemic risk. 6. Democratic control of money. Central banks accountable to democratic institutions rather than to financial markets, with mandates to serve full employment and equality rather than just price stability. These aren't utopian fantasies. Versions of these policies exist in various countries and historical periods. They're politically difficult because they threaten the interests of the powerful, which is precisely why they're necessary. The power of collective action. Individual investors will always be at a disadvantage in financial markets. The game is rigged against them by design. But collective action changes the equation. When workers organize into unions, they can demand better wages and working conditions. When citizens organize politically, they can demand regulations that protect the public interest. When communities organize economically, they can create alternative institutions, credit unions, cooperatives, mutual aid networks, that operate on different principles than Wall Street. The history of capitalism is also a history of resistance to capitalism. Populist movements, labor unions, social democratic parties, cooperative movements, these have all pushed back against the concentration of wealth and power. Sometimes they've won. More often they've lost or been co-opted. But the struggle continues, because the alternative is to accept that crashes will keep happening, wealth will keep concentrating, and ordinary people will keep being sacrificed to protect the system. Part 14. The psychological dimension. There's another layer to this story that's often overlooked, the psychological impact of financial crises. The trauma of 1929. The generation that lived through the Great Depression was marked by it for life. Even decades later, people who had survived the 1930s hoarded food, distrusted banks, saved obsessively, and avoided debt like poison. They had learned that prosperity is fragile, that the system can't be trusted, that you have to protect yourself because no one else will. This trauma shaped American politics for decades. The New Deal coalition dominated for nearly 50 years, in part because voters remembered what unchecked capitalism had done to them. But memory fades. By the 1980s, a new generation had come of age that hadn't experienced the Depression. They were receptive to the message that regulation was stifling, that markets should be free, that greed was good. The cycle began again. The amnesia of prosperity. This is one of capitalism's most insidious features. Success creates the conditions for future failure. When times are good, when prosperity seems limitless, we forget the lessons of the past. We believe that this time is different, that the old rules don't apply, that we've entered a new era where crashes are impossible. This amnesia is encouraged by those who profit from bubbles. Financial institutions don't want you to remember 1929 or 2008. They want you to believe that investing in stocks, or buying real estate, or putting your money in their funds is safe and smart. By the time you realize it isn't, they've already cashed out. The cult of optimism. American culture has a deep-seated bias toward optimism. We're taught to believe in progress, in innovation, in the power of positive thinking. This serves capitalism well. An optimistic population is a consuming population. They borrow against the future, spend money they don't have, and invest in markets they don't understand. But optimism without critical analysis is just naivety. And in financial markets, the naive are prey. The people who survived 1929 and 2008 weren't the optimists. They were the skeptics, the ones who asked hard questions, who didn't believe the hype, who understood that what goes up can come down. Part 15. The Modern Bubbles. As I write this in 2025, we're living through several potential bubbles. Cryptocurrency, a new asset class built on blockchain technology, promising to revolutionize finance. Some investments have generated spectacular returns. But much of the market is driven by speculation, hype, and a belief that this time is different. Sound familiar? Tech stocks. Companies valued at hundreds of billions despite never turning a profit. Justified by promises of future disruption and growth. The echoes of the dot-com bubble are clear. Real estate. In many cities, housing prices have become completely detached from what ordinary people can afford. Investment firms buy up houses to rent them out, turning housing from a basic need into a financialized asset. Everything bubble. After years of near-zero interest rates and money printing by central banks, asset prices across the board have inflated. Stocks, bonds, real estate, art, collectibles, everything is expensive because there's nowhere else for capital to go. Will these bubbles pop? When? How badly? No one knows for certain. But history suggests that they will, eventually. And when they do, the pattern will repeat. Ordinary investors will lose, insiders will profit, governments will intervene to protect the system, and wealth will concentrate further. Unless we decide to break the pattern. Part 16. The Choice Ahead. The story of Black Thursday isn't just history. It's prophecy. It shows us what happens when we allow financial markets to operate without meaningful democratic control. It shows us who wins and who loses when the inevitable crash comes. It shows us that reform that leaves the fundamental structure intact will always be temporary. We face a choice. Option 1. Repeat the cycle, continue on the current path. Allow wealth to concentrate. Believe in the promises of new technologies and new investment opportunities. Wait for the next crash. Bail out the banks. Watch inequality grow. Repeat. Option 2. Break the pattern, recognize that the system is designed to produce these outcomes. Build political power to fundamentally restructure the economy. Tax extreme wealth. Democratize capital. Create institutions that serve people rather than profits. Accept that this will be difficult, that the powerful will resist, but that it's necessary. The stakes. This isn't just about money. It's about what kind of society we want to live in. Do we want a world where a small elite controls vast wealth while millions struggle? Where crashes periodically wipe out ordinary people's savings while insiders profit? Where democracy is hollowed out by the power of capital? Or do we want a world where economic security is a right, not a privilege? Where crises are prevented rather than exploited? Where power is distributed broadly rather than concentrated narrowly? The choice seems obvious. But the path to get there is hard. It requires us to see through the mythology of meritocracy and recognize that capitalism concentrates wealth by design. It requires us to organize collectively rather than pursue individual solutions. It requires us to imagine alternatives to the current system, and to fight for them even when they seem impossible. Conclusion. The real story of Black Thursday, October 24, 1929, was not the day Wall Street died. It was the day the mask slipped. For a brief moment, the true nature of the system was visible. An elaborate mechanism for transferring wealth from the many to the few, dressed up in the language of opportunity and meritocracy. The bankers who walked calmly through the panic, who had sold at the top and would buy at the bottom, who shaped the recovery to protect their interests, they understood something that most Americans didn't. Crises are not disasters for everyone. For those who control capital, they are opportunities. The school teachers and shopkeepers who lost everything, the families evicted from their homes, the workers who stood in breadlines, they learned a harder lesson. In capitalism, you are only as secure as your ability to weather a storm. And the storms are designed to wipe out those without resources. This is the story they don't tell in economics textbooks. It's too cynical, too dark, too threatening to the legitimacy of the system. But it's true. And it keeps happening because we keep forgetting. We forget that the 1920s boom was built on debt and speculation. We forget that the insiders sold early. We forget that the New Deal, while genuine reform, left the basic structure of capitalism intact. We forget that wealth reconcentrated over the following decades. We forget that 2008 followed the same pattern. We forget because memory is painful. Because optimism is easier than vigilance. Because the mythology of meritocracy is more comforting than the reality of systemic extraction. But Black Thursday remembers. The ticker tape that couldn't keep up with the collapse. The crowd gathering in shocked silence on Wall Street. The bankers meeting to protect their interests. The fortunes evaporating while insiders watched calmly. The crash didn't destroy Wall Street. It perfected it. It revealed that the system could survive anything, even self-destruction, as long as the state was willing to step in to protect it. It proved that ordinary people would accept enormous suffering if they believed the alternative was complete collapse. It demonstrated that wealth could be extracted on a massive scale, and power would remain intact. When they called it the Great Depression, they named the emotional reality, a profound, grinding despair that settled over the nation like fog. But for the financial elite, it was something else. A great opportunity. A great reorganization. A great consolidation. They didn't lose everything. They took it back later, with interest. That's the real story of October 24, 1929. Not the end of an era, but the beginning of a pattern. A pattern that continues to this day. A pattern that will continue until we decide to break it. The question is, will we? The ticker tape has long since been replaced by electronic screens. The marble halls of the 1929 Stock Exchange are now museum pieces. The faces have changed, the technologies have evolved, the languages of finance have become more complex. But the underlying dynamic remains the same. Capital concentrates. Insiders profit. Outsiders lose. Crises redistribute wealth upward. Reforms protect the system more than the people. The cycle continues. October 24, 1929, taught us everything we need to know. The question is whether we'll learn the lesson before the next crash comes. Or whether we'll keep playing a game we can't win, against opponents who wrote the rules, in a casino where the house always takes its cut. The choice, as always, is ours. But the clock is ticking. And somewhere, right now, someone is getting ready to sell at the top.